Investing in the stock market seems like a daunting task for most people, with 66% of people aged 18 to 19 saying that it is intimidating. In this video, I will lay out some actionable steps that a beginner can take to get started on their investment journey. To beginners, investing can seem like a highly complicated, time-consuming task. This often leads to overthinking and then never getting started. This actually happened to myself when I missed the entire 2019 bull run by keeping on the sidelines and not investing due to lack of confidence, missing out on a 30% market gain. I wish I had seen a video like this to give me the confidence to get started earlier. First of all, you need the right mindset to be a successful investor. This is the most important part. Investing in the stock market, you need a long-term time horizon. You need to be comfortable with the value of your portfolio falling without panic selling. If you're constantly buying and selling, you're not an investor, you are a trader. And it's a lot harder to be a successful trader. When investing, it's vital that you only invest money that you don't need in the short term, so at least not for the next 3, but ideally 5 years. This is as if your investment's value falls, it only becomes a loss when you sell, so you don't want to have to liquidate your position before it has had time to recover. Based on decades of historical data, it is very likely that the market will recover if given enough time. As a new investor, it is best to invest in assets that aren't very volatile. This is as the vast price swings seen in volatile assets will likely cause fear and panic in inexperienced investors. The natural emotion to feel when the price shoots up is greed, causing excess buying, and when the price drops is fear, causing panic selling. This is known as FOMO trading. Buying high and selling low. Sticking to safer investments with less volatility lowers the chance of making this mistake. This is why I think beginners should start off investing in broad market ETFs. These are ETFs that contain a large selection of stocks from a particular market, including all sectors, giving excellent diversification. Not only do these ETFs usually provide a great return, but they also require very little research to be done by the investor and are extremely simple. A prime example is the S&P 500, which contains the 500 largest profitable companies in the United States. The S&P 500 has a particularly great return, with 10.4% annualized return over the last 30 years, and then looking at just the last 5 years, it's had an impressive 16.5% annualized return. This is a phenomenal return that any investor could have achieved simply by putting their money into an S&P 500 ETF and leaving it. No research or effort required at all. All countries around the world that have a stock exchange will have an ETF that tracks the market. For instance, with the UK, I like the FTSE 250 ETF, which tracks the 250 medium-sized companies based in the UK. There are also ETFs that cover the entire world, such as the FTSE All-World ETF. These ETFs are very diversified, meaning the only risk is that of the market. If you want to understand what ETFs are more, check out my video on them. The link will be in the description. ETFs, unfortunately, don't just go up linearly. Like all assets, the price fluctuates up and down. This is important for beginners as it allows them to get used to this price movement, which is crucial for investors. It's rare for there to be a huge price swings in the market ETFs like we often see in individual stocks, so there's unlikely to be an event that would cause an experienced investor to panic sell in a knee-jerk reaction. But the movement is enough to get used to the falls and rises, allowing investors to think rationally if larger drops happen in the future. Investing can be made as complicated or kept as simple as you like. Simply investing money into a broad market ETF is a perfectly sufficient strategy for the vast majority of people with excellent results. Warren Buffett, arguably the greatest investor of all time, regularly states that simply owning the S&P 500 is enough for most people. For instance, £10,000 invested into the S&P 500 index in 1991 and leaving it while reinvesting dividends would have grown to £301,000 by 2021. A ridiculous return. This really demonstrates the power of compound growth with long-term investing. As you get more confident and comfortable investing in the stock market, you can start to explore the vast amounts of ETFs available to construct a more specialized investment strategy. In 2020, there were 7,602 ETFs available globally, so plenty of options. For example, to name a few, you can focus on specific sectors, ESG criteria, or on dividend history, as I do for my dividend portfolio. If you're interested in which dividend ETFs I have in my portfolio, check out my video where I talk through it. The link will be in the description. As confidence grows even more, the next step for investors, if desired, is to start adding individual company stocks to their investment portfolio. When stock picking, a good starting point is to choose from companies that have products or services that you love. For example, 68% of my video's viewers use Apple devices to do so they may feel more inclined to invest in Apple shares. It's only worth investing in companies that you believe will outperform the market though, so greater than around 7 to 8% per year. Otherwise, there's no point taking on the risk increase when you could get the same or higher return with lower risk from a broad market ETF. A good example of me is Legal & General, one of my favourite stocks that I believe will return significantly in excess of 10% per year. Check out my stock analysis video for the company if you haven't already. The link is in the description. Finally, it is crucial to understand that the stock market can act irrationally, going up or down for unknown reasons. Any money you invest has the risk of being lost, but the loss only becomes real when you lock it in by selling. And just because historically most major markets, like the S&P 500, have always gone up over the long term doesn't mean that they will continue to do so. An example of when this doesn't happen is Japan's market index, the Nikkei 225. This market peaked in 1990 and hasn't recovered yet, trading sideways for large periods. However, the market has seen considerable gains during the last decade. I just want to finish off by reminding you that nothing in this video is financial advice. It is simply me stating my opinion for entertainment purposes. If you found this video helpful, please do hit the like button, and good luck on your investment journey.